This is Paris Hoover, your Patton University online course instructor for the semester. Unit 8, Introduction. While equity securities represent a share of ownership in the issuing organization, bonds are debt securities in which the issuing company, in essence, borrows from and owes monies to the bondholders. Underwriters evaluate various factors when establishing the fair value of bonds. Relevant factors include the par value that will be paid to bondholders on the redemption date. Stated or coupon interest rate will be paid at the regular intervals throughout the life of the bond. Number of periods before redemption and the current market interest rate for investments of similar nature and risk. With this information, underwriters establish the estimated present value of future cash flows associated with the bond investment. Although bonds are typically considered a more conservative investment compared with stocks, bond investments carry risk as well. One such risk is bond price volatility. Depending on changes in interest rates and the credit rating of the issuing company, bond prices are subject to change. The more time a bondholder has before redemption, the greater the risk will be. Duration measures volatility and risk of bonds, much like beta measures risk of stock. Duration provides a relationship between redemption yields and bond prices by incorporating elements such as time to redemption, credit rating, and redemption yield. One inherent weakness of duration is the assumption of a linear relationship between redemption yield and bond prices. In reality, the relationship should be depicted by a curved line. When small changes in redemption yields occur, the difference would be fairly minor. However, for larger changes, the measure of convexity must be incorporated with the measure of duration. When fund managers seek to reduce bond investment risk, they may utilize bond futures to hedge the risk of price volatility and the time to redemption. Yield curves are instrumental in bond valuation and bond investment analysts. Yield curves show how interest rates change with the maturity rate of the investment. Different yield curves represent varying levels of credit risk. In this final unit of the course, you'll cover the above topics in greater detail, once again, through a series of textbook reading, journal articles, and videos. Learning objectives. 1. Calculate the fair market value and effective yield of bond investments. 2. Distinguish the effects of bond price convexity and bond futures in bond portfolio management. 3. Explain how swaps are used to hedge against interest rate and price fluctuations. Chapter 40, Bond Prices and Redemption Yields, page 751 to 762. As with other financial investments, the fair prices of bonds are based on the present value of expected future cash flows. The general formula for estimating the fair price of a bond is shown below. Where P is the fair price of the bond, its dirty price, which includes accrued interest, C is the regular coupon payment each period, B is the money value to be paid to the bondholder at redemption, R is the rate of discount per period, and N is the number of periods remaining to redemption. An important simplification that has been made in equations 1 and 2 is the use of the same rate of discount for all the future cash flows. This assumes that interest rates are the same irrespective of the term of the investment. When valuing a bond, an investment analyst could use a different rate of discount for each cash flow in order to take account of the fact that there are different interest rates for the different maturities. However, typically a single rate The redemption yield or yield to maturity is applied to all future cash flows. The redemption yield of a bond could be looked upon as an average of discount rates applicable to the various future cash flows. The redemption yield indicates the average annual return to be received by an investor holding a bond to maturity. Interest rates are not the only determinants of discount rates. Bonds with relatively high default risk need to yield the high expected rate of return to compensate for the risk. The rate of discount is the required rate of return from a bond. The required rate of return can be regarded as the sum of the yield on bonds that are free of default risk, and a risk premium to reflect the default risk of the bond being valued. High default risk entails high required rate of return and hence a high discount rate. It follows that for any particular stream or of future cash flows, high-risk bonds would have higher rates of discount and hence lower fair prices than low-risk bonds. Two conclusions that can be drawn from this account of bond pricing are first, that bond prices have an inverse relationship to interest rates, and second, that they have an inverse relationship to the risk of default. High interest rates and high risk are associated with low prices. Discount models estimate the fair prices of bonds. The fair price of a bond is the price that an investment analyst believes to be justified. Market prices of bonds may differ from fair prices. This may be because market prices fail accurately to reflect all relevant information, or because the estimated fair prices are poor estimates. The use of a single discount rate rather than a time-varying discount rate on all future coupon and principal receipts is a potential source of error. Another source of error is the possibility of inaccurate estimates of discount rates. The estimation of future discount rates requires an understanding of the factors that affect discount rates. This divides into understanding the determinants of risk-free rates and the determinants of risk premiums. If a single discount rate is to be used, the risk-free rate is the redemption yield on a government bond of similar maturity, more precisely duration, to the bond being analyzed. If a time-varying risk-free discount rate is to be used, it may be necessary to produce estimates based on the factors that influence government bond redemption yields. Fleming and Remolona, when investigating U.S. government bonds, found that their prices were influenced by economic data. In particular, data on employment, inflation, and short-term interest rates were found to be important determinants of redemption yields. Other relevant factors included retail sales and industrial production. Ewing looked for factors that appeared to influence the default risk premiums to be added to government bond redemption yields when estimating discount rates for corporate bonds. Industrial production, inflation, and short-term interest rates were found to be important factors. These factors may affect the risk of default by impacting on the financial positions of companies. Ewing acknowledged that other researchers had found overreaction to be a factor in the determination of risk premiums, which suggests that behavioral finance factors may be partially responsible for the size of risk premiums. An important distinction to be made when considering bond prices is between the clean and dirty prices. When a bond is purchased, the buyer must include in the purchase price a sum corresponding to the seller's share of the next coupon. If the coupon is paid 6 monthly and the bond is sold 3 months after the last coupon payment date, the seller would require the price to include half the next coupon so that holding the bond for the previous 3 months provides an interest yield. The rights to the coupon accumulated by the seller are referred to as accrued interest. The clean price of a bond excludes accrued interest, whereas the dirty price includes it. Quoted prices are usually clean prices, whereas the price is to be paid is the dirty price. Page 755. Valuing coupon streams as annuities. An annuity is a stream of future payments, typically a fixed sum of money each period. The stream of coupon payments on a bond can be seen as equivalent to an annuity. Correspondingly, the prospective series of coupon receipts can be valued as an annuity. The equation for valuing an annuity is shown below, where AV is the value of the annuity, C is the coupon, N is the number of periods for which the coupon will be paid, and R is the periodic interest rate. The equation shown is applicable when the next coupon receipt is a full period away. The value of the bond can be estimated as being equal to the value of the annuity plus the present value of the sum payable at maturity, where BV is the estimated value of the bond and M is the sum to be received by the bondholder at maturity. Despite the appearance of precision, this remains merely an estimate of the fair price. This is partially because R is a proxy for the series of separate interest rates, each applicable to a particular future cash flow. Page 756. Consols and PIBs. Consols are undated government bonds. The government may choose to pay the fixed periodic coupon in perpetuity. There is no obligation to ever redeem the bond. PIBs, permanent interest-bearing shares, are issued by building societies. Like consols, PIBs pay a fixed annual sum in perpetuity. The building society need never repay the original investment. Preference shares are issued by firms and pay a fixed annual dividend in perpetuity, with no obligation to repay the initial sum paid for the shares. The factor that consols, PIBs, and preference shares have in common is the perpetual nature of the coupon dividend payments. When cash flows are perpetual, equation 1 or 2 can be simplified to equation 5. P is the fair price of security, C is the periodic coupon, and R is the discount rate. It can be noted that equation 5 implies inverse proportionality between discount rates and asset prices. If the discount rate halves, the fair price doubles. If the discount rate doubles, the fair price halves. Since discount rates and interest rates are closely related, this implies a relationship between asset prices and interest rates, which is close to being inversely proportional. Accrued interest and rebate interest. If an investor buys a bond between coupon payment dates, the investor receives the next coupon, whereas the seller receives no coupon. This means that the seller receives no coupon return from holding the bond since the previous coupon payment. To deal with this, an adjustment is made. The buyer adds the value of the accumulated coupon rights to the purchase price. This addition is known as accrued interest. Accrued interest ensures that the next coupon is shared between the buyer and the seller in proportion to the amount of time each has held the bond. The price of the bond, excluding accrued interest, is a clean price. The price inclusive of the accrued interest is the dirty price. So the buyer receives the whole of the next coupon, but will already have paid part of it to the seller. Please continue reading to page 762. Chapter 42, Bond Price Convexity, pages 779 to 784. The problem of convexity. Money duration merely provides an approximation to the relationship between yield changes and bond price movements. This is illustrated by figure 42.1. Figure 42.1 shows the price over yield relationship for a bond together with a single line representing money duration. It can be seen from figure 42.1 that for small changes in yield, such as R0 to R1 or R0 to R2, The price change indicated by money duration along a straight line is a fair approximation to the actual price change as shown by the curved price over yield relationship. However, for large yield changes such as R0 to R3 or R0 to R4, the money duration line provides a poor estimate of the actual price change. Money duration underestimates price rises and overestimates falls. In both cases, a new bond price is underestimated. The inaccuracies arise because money duration fails to take account of the convexity of the actual price over yield relationship of a bond. Page 782. The value of convexity. Two bonds with identical durations, prices, and yields may have different convexities. In figure 42.2, the curve A shows the price over yield relationship for bond A. The curve B does so for bond B. It can be seen that bond B has greater convexity than bond A. This gives bond B an advantage over bond A. Changes in yield from R0 in either direction raise the price of B relative to that of A. This renders B preferable to A, especially if high validity is expected. This should entail B selling at a higher price and hence lower yield compared with A. It is unlikely that a situation in which the bonds have identical prices and yields will persist. Construction of bond portfolios. The construction of a bond portfolio is frequently based on taking a view with respect to interest rates. If interest rates are expected to fall so that bond prices are expected to rise, a portfolio with a relatively high duration would be constructed. Conversely, an expectation of a rise in interest rates would entail a portfolio with low duration, so that potential losses are reduced. It is not just duration that a bond portfolio manager needs to be concerned with. Convexity has value in that it leads to higher bond prices following interest rate movements when compared with investment with zero convexity. High convexity bonds provide the benefit to a greater extent than low convexity bonds. The benefits of convexity are greater when interest rate changes are relatively large. This implies that the portfolio manager needs to consider the prospective size of interest rate movement as well as the direction. A bond with high convexity will tend to have a relatively low redemption yield. The advantage bestowed by high convexity would be offset by a lower prospective yield. If interest rate movements are small, the gains from convexity would not compensate for the low yield. So if a portfolio manager expects a small interest rate change, bonds with low convexity should be chosen. If the expectation is there will be a substantial interest rate movement, high convexity bonds should be chosen. Convexity is greatest for low coupon, long maturity, and low redemption yield bonds. Convexity can be calculated and combined with measures of duration when evaluating the potential effects of interest rate changes on bond prices. Since measures of duration are accurate only for small changes in interest rates, a convexity correction is required in the case of large interest rate movements. To estimate the effects of relatively large interest rate changes on bond prices, it is necessary to combine an estimate of convexity with an estimate of duration. Callable bonds. Some corporate bonds are callable. This means that the issuer has the right to repurchase the bonds at a predetermined price. A rise in bond price that renders the repurchase desirable would be brought about by a fall in market interest rates or an improvement in credit rating of the bonds. Under these circumstances, the issuer could repurchase the bonds and issue new bonds at a lower coupon rate. The issuer would choose to repurchase, since that would allow for a reduction in financing costs. Bonds with relatively high coupon could be repurchased with money raised from the sale of bonds with a lower coupon. The issuer thereby reduces coupon payments. The predetermined price at which the issuer has a right to repurchase puts an upper limit on the value of bonds. No one would pay a higher price knowing that they could be forced to sell at the predetermined price. The price over yield relationship for a callable bond has an upper limit to the price, shown in figure 42.3. The maximum price is depicted as P max. An implication of the upper limit to the price is that around point X, the convexity turns into concavity. Another implication is that the coupon rate on a callable bond will be higher than the coupon rate on a bond without the call feature. If investors face a ceiling on their prospective capital gains, they would require an enhanced coupon yield in compensation. Effectively, investors are providing the issuer with a call option. The investors would require payment for the call option. The payment to the investors takes form of increased coupons. Conclusion. The relative certainty of bond cash flows make it worthwhile to make estimates that would be pointless in the case of shares, whose future cash flows are much less certain. One such estimate is duration, another is convexity. Duration provides a relationship between redemption yields and bond prices, a relationship that permits estimates of the effects of redemption yield changes on bond prices. However, the relationship provided by duration measures is a linear relationship, whereas the actual relationship is a curve rather than a straight line. The straight line approximates the curve reasonably well when redemption yield changes are very small. For larger changes in redemption yield, a reliable estimate of bond price change requires a measure of convexity to be combined with the measure of duration. The effect of the redemption yield change on a bond price is a combination of the effects that operate via duration with the effects that operate through convexity. The degree of detail offered by convexity estimates may seem excessive. However, an institutional investor might hold more than £100 million in a particular bond issue. Apparent details translate to substantial monetary values when investments are very large. Chapter 44, Yield Curves and Interest Rate Futures, pages 804 to 819. Yield curves. A yield curve shows the relationship between the redemption yield bonds and the maturities of those bonds. Figure 44.1 illustrates three possible shapes of the yield curve. These are not the only possible shapes. The number of possible yield curve patterns is infinite. On the far left of the yield curve, the investments are very short-term deposits that can be withdrawn without notice, or with just a few days' notice. On the far right, the investments have very distant maturities, for example, 25-year government bonds. The most common yield curve pattern is for yields to rise with increasing maturity, but for the rate of increase to diminish. The diminishing rate of increase implies that for distant maturities, increases in maturity entail little or no increment to yields. The yield curve labeled normal illustrates this pattern. The yield curve sometimes exhibits a downward slope, as illustrated by the curve labeled inverted. The flat yield curve shows a situation in which interest rates are the same irrespective of the length of time for which money is invested. Such a situation is extremely unusual. Explanations of the term structure of interest rates, and hence the shape of the yield curve, can be divided into three theories. These three theories are pure expectations, expectations with risk premium, and market segmentation. According to the pure expectations theory, long-term interest rates can be seen as averages of current and expected future short-term interest rates. So, for example, the 12-month interest rate would be an average of the current 3-month rate and expected rates for each of the subsequent 3-month periods. Likewise, the 5-year interest rate would be an average of the current 1-year rate and the expected 1-year rates for each of the subsequent 4 years. Suppose that the spot 1-year interest rate is 10% PA, and the expected rate for the following year is 12% PA. The current 2-year interest rate should be the geometric mean of these two rates. The 2-year rate is 1.11 minus 1 equals 0.11 as a decimal, which is 11% PA as a percentage. The 2-year rate is the rate which when compounded over 2 years gives the same final value as 10% in 1 year compounded with 12% in the following year. According to the pure expectations theory, investors should have no preference between the alternative of investing 11% PA for 2 years and the other alternative of investing for 1 year at 10% PA, whilst anticipating investment of the proceeds for a further year at 12% PA. If the pure expectations theory is an accurate explanation of the level of long-term interest rates, it is possible to infer market expectations of future interest rates from the yield curve. The implied future interest rates are referred to as forward interest rates. In the previous example, an investor knowing that the 1-year rate is 10% PA and the 2-year rate is 11% PA could deduce that the 1-year rate expected to be available 1 year from now is 12% PA. In other words, the forward interest rate is 12% PA. The forward interest rate is the rate which, when compounded on the 1-year rate of 10% PA, produces the same sum as 11% PA compounded over 2 years. The pure expectations theory assumes that investors are indifferent between investing for a long period on the one hand and investing for a shorter period with a view to reinvesting the principal plus interest on the other hand. For example, an investor would have no preference between making a 12-month deposit and making a 6-month deposit with a view to reinvesting the proceeds for further 6 months, so long as the expected interest rates are the same. This is equivalent to saying that the pure expectations theory assumes that investors treat alternative maturities as perfect substitutes for one another. The pure expectations theory assumes that the investors are risk neutral. A risk neutral investor is not concerned about the possibility that interest rate expectations will prove to be incorrect, so long as potential favorable deviations from expectations are as likely as unfavorable ones. Risk is not regarded negatively. Most people are not risk neutral. They are risk averse. They dislike risk. Risk-averse investors are prepared to forego some investment return in order to achieve greater certainty in regard to the value of investments and the income from them. As a result of risk aversion, investors may not be indifferent between alternative maturities. Attitudes to risk may generate preferences for either short or long-term maturities. If such is the case, the term structure of interest rates would reflect risk premiums. If an investment is close to maturity, there is little risk of capital loss arising from interest rate changes. A bond with distant maturity would suffer considerable capital loss in the event of a large rise in interest rates. The risk of such losses is known as capital risk. To compensate for the risk that capital losses might be realized on long-term investments, investors may require a risk premium on such investments. A risk premium is the addition to the interest or yield to compensate investors for accepting risk. This tends to impart an upward slope to a yield curve. This tendency toward an upward slope is likely to be reinforced by the preference of many borrowers to borrow for long periods. Such borrowers may be willing to pay an interest premium for the facility of borrowing long term. There is a form of risk that would tend to have the opposite effect on the slope of a yield curve. This is known as income risk. Some investors may prefer long maturity investments because they provide greater certainty of income flows. For example, a conventional UK government bond pays a consistent coupon every 6 months until the bond reaches its redemption date. On the other hand, interest receipts from bank deposits can change frequently. Income flows from a bank deposit are very uncertain. This uncertainty is income risk. If investors have a preference for predictability of interest receipts, they may require a higher rate of interest on short-term investments to compensate for income risk. This would tend to cause the yield curve to be inverted. The effects on the slope of the yield curve from factors such as capital risk and income risk are in addition to the effect of expectations of future short-term interest rates. If money market participants expect short-term rates to rise, the yield curve would tend to be upward sloping. If the effect of capital risk were greater than the effect of income risk, the upward slope would be steeper as a result. If market expectations were that short-term interest rates would fall in the future, the yield curve would tend to be downward sloping. Dominance of capital risk aversion over income risk aversion would render the downward slope less steep, or possibly turn the downward slope into an upward slope. Dimson found that over the 20th century, on average, long-term bonds showed a modest premium over short-term investments. In the UK, the long end of the maturity spectrum averaged a 0.3% premium over a short end. For a group of 12 countries, the premium was 0.6% on average. King and Kerman investigated U.S. interest rates between 1951 and 2001 and found that expectations theory provided a reasonable approximation to the observed term structure of interest rates. However, they found that there were deviations from the term structure predicted by expectations, and that the deviations would be ascribed to risk premiums. They found that there was some tendency for the whole yield curve to move up and down, indicating that there were factors that affected both short and long-term interest rates simultaneously. Not all studies have supported the expectations theory. For example, a study by Sarno rejected the expectations hypothesis in a sense of pure expectations plus a constant risk premium. Please continue reading to page 819.